Good afternoon, welcome to Market Wrap number 183. This is Stuart Williamson at the helm, and we're in Liverpool, in the historic city, searching for some property opportunities. Liverpool is number 5 in the best performing property markets of 2023, according to Daily Telegraph. That momentum has been building since 2008, European City of Culture, Eurovision Song Contest last year, so it's very much a vibrant sort of in place. Much of this is centred around the docks, where major regeneration is taking place, including Everton's £500 million stadium, a new cruise ships terminal. 10 Streets is one of the fastest growing tech clusters in the UK. Latest Supla data says that it only takes 17 days to sell a property in Liverpool. That's half the UK average. Amazing. In the vast former tobacco warehouse in Stanley Dock, right next to where I am, you can buy a 2-bed property for £265. But also in Egbert, Anfield, Toxteth, places like that, you can buy 3-bed houses for £110,000 with 7% yield, according to Rightmove. This is the Titanic Hotel. Quite extraordinary hotel, amazing sized rooms. Okay, interest rates. What's going on this week? Bank of England has held rates the same again, 5.25%. Great news. Is this an indication that rates have peaked? I don't know. The Times newspaper says they've held base rates after 14 consecutive rises. This is the third time they've held them, so it should be, they believe, the end. Is that what the Bank of England is saying? Well, I think it's Mr. Bailey recently wrote to the Chancellor saying that they're holding rates because inflation was at 11.1, it's now at 4.6, so it's gone very well. However, we still have some way to go. We'll watch the data carefully and keep interest rates high enough for long enough to ensure that inflation falls all the way back to 2% target. That's what he said in his letter. But there's hope it won't be long before rates do start falling. And if we go to an article at the Daily Telegraph, they said that money market people are saying that they believe rates will fall by at least 1% over the next 12 months. You can currently get a two-year fix at below 5% now. The average is around just below 6%, but you can get fixed at below 5%, which is good. So what does the Telegraph headline actually say? Money markets are predicting Bank of England will reduce interest rates a quarter point every quarter going forward, starting in May. Why do they believe this? They believe this because of the recent fall, according to the ONS, Office of National Statistics, recent fall in the GDP, the gross domestic product of the UK. It fell by 0.3%, and it's caused people like Goldman Sachs and JP Morgan to actually reduce their expectations of the growth in the UK. So that's not great for the economy, not great for bond sales, not great for confidence. So they'll have to reduce interest rates further to stimulate the market. So it does look like it's not a bad time to be buying. Think about it. But how do you make these buying decisions? So I put together a few points with the help of the Telegraph again to make good resolutions in the new year and get some good plans going. Number 1, be in it for the long haul. Had a client say to me last week, I wanted to buy a property for 3 years, sell it and then buy a home. It's not worth it. Keep it for 5 years as a minimum or don't get involved. The acquisitional costs of buying take you at least 5 years to get back and get into a profit. 2, set your goals realistically. Know what they are, stick to them. So before you spend a penny, take the time for an unheard assessment of your financial circumstances. What can you afford? Add 25% to costs. Can you still afford it? If that's the case, then it's not a bad thing to do. Don't be frightened to say I made a mistake. We all do make them, and it's a better person that says I've made a mistake than one doesn't. So be honest with yourself and your family of what you can afford, and there's no shame in changing your mind. Cash savings sometimes work better while you're thinking about things. Now, number 3, accept uncertainty. Property markets invariably recover. However, it's not certain the future will always look like the past. Past performance is no guide to the future, as they say in the stock market world. Things might not go as well as you hoped. So be aware that might be the case, and be aware things might not run as smooth as you hoped. And if that is the case, accept it. Now, diversify. After I've said all those negative things about property, you might be saying to yourself, whoa, I don't want to get involved in that at all. It's not a great idea. But there are good reasons why you should buy property, in that it should always make you rich if you do these things. Buy for the longer term. Okay? Over the longer period, inflation will erode away a mortgage, you will make money. And then the second tool is, don't put all your eggs in one basket. Diversify. Don't buy all your buy-to-lets in Whitby, I'm from Whitby, because you like it. Okay, if you had another second COVID experience, the place would be actually ruined. Look at different things, not just buy-to-let. Look at houses of multiple occupancy. Look at some sorts of student accommodation. Look at builders bonds, spread your risk, and go into stock markets and use other sorts of concepts. Save your tax, use tax planning. It's all very good to get great rental income and get a great capital gain, but if you blow it all on the tax man, it's not a great idea. So things like SPVs and proper ownership methods. Be as hands-free or as hands-off as you want. You don't need to be all the way in it, or you don't be completely hands-off. Just do as you see fit. And if you get hold of a good person who can look after you, use those people. Remember, keep it simple. If you keep it simple, it'll work. Keep your costs down. You're going to pay 5% stamp duty if you buy from the UK, buy in England if you buy from overseas. So look at that. You'll have to pay a mortgage man, you'll have to pay a lawyer, but make sure you don't pay much more than that. Be careful and savvy. Regularly monitor what you're doing. Every month, give your agent a call. Just check it's going. But don't do it every week. Don't go mad. There's no point. Beware of fads. Every now and again, an investment fad takes hold. Wary of committing serious sums of money to something that hasn't been tested, because you don't know what's going to go on. You talk about buying in Vietnam, for example. What a great idea. However, and you can have a lease for 25 years. But has anyone ever tested that? No, because it hasn't gone for more than 25 years yet. Avoid things like airport car parking. They don't work. Be careful there. Keep quiet. Don't tell everyone what you're doing. If you do, and then you suddenly find you've made a mistake, it's going to be pretty bad and pretty embarrassing for you and harder to pull out of. So if you decide to invest all your money in Whitby, don't tell all your friends. I would keep your decisions to yourself. And number 11, if you don't understand it, don't invest in it. Get a clear explanation, understand all the steps, and then if you then understand what's going on and how you make money, then happy days, jump in. So there we go. That's it. The summary for this week. Interest rates are falling. The market will pick up. Loughborough and south, it's flat or going down. Loughborough and north, it's going up. So it's not a bad place to buy north of that line. But remember, if you do buy, have a plan. Stick to it. Okay, thank you very much for listening. That's 183 finished. Take care. Bye-bye.